My name is Tyler Rosenlicht. I'm a portfolio manager at Cohen Steers, where I help oversee our global listed infrastructure strategies as well as our natural resource equity strategies. I would start by saying I think everybody has the same goals when it comes to clean energy and the energy future. We all want clean, cheap, accessible energy. But I think where we've come to, and sort of what a lot of our research has led to, is a realization that the notion of the energy transition might actually be a little bit misleading. We think there's going to be a lot of growth in renewable energy going forward, but we also think traditional forms of energy are going to be required for quite a while. And there's going to be a big shift in market share. But really, what we're going to be in is an energy addition world where we're going to need to basically get all the resources of energy that we possibly can to satisfy demand going forward. And the reason that we get to that conclusion is, we actually start our analysis a little bit differently, I think, than other places. So we've seen a lot of analysis that basically starts with desired temperature outlook. Hey, we only want heating to be 1.5 degrees Celsius. What does that mean for the energy future? And that's a good way to go, but I think that is a little bit more in the hypothetical. And for us, we want to take a more realistic, real world approach. So what we've done is we've said, let's try to estimate how much demand for energy is going to grow in the future. And then let's figure out how to satisfy that demand. And candidly, trying to estimate energy demand is obviously a really big item, but it really just takes three key assumptions. So when you think about the demand for something like energy, it's what's the population growth, more people, more energy. It's what's real GDP growth, because a bigger economy, more energy. And then there's a really tricky one, which is the energy efficiency or the energy intensity of the global economy. So what we've done is we've said, let's take views on population growth, let's take views on economic growth, and let's assume some pretty big improvements in energy efficiency. And we still see a world where global energy demand is going to rise quite a bit between now and 2040. We then make assumptions on things like coal demand, which we think is going to decline a lot, crude demand, which we think will grow a little bit and then start to plateau and decline a little. And we're basically solving for what is the renewable investment required to sort of bridge that demand requirement. And again, what we see is it's not necessarily an energy transition in sort of electrons. It is a big market share shift with huge gains in renewable development and renewable market share, but still a lot of resilience where things like crude oil and natural gas in aggregate are going to continue to grow for the next few decades. So huge investment opportunities and huge implications. We think it's really important to think about, what's it actually going to require to power the global economy. When we look at the investment opportunities across this broad energy universe, we sort of break the world into four quadrants where we see big winners and big losers across both traditional businesses and alternative businesses. So how I would sort of walk you through each of these quadrants is we think there are traditional energy companies that are going to be very resilient and have cash flows that last a really long time, way longer than the market currently believes. Conversely, there's going to be traditional businesses that are going to be melting ice cubes and are going to degrade really quickly and offer really poor performance. We think in the alternative space, there are a lot of businesses, though well-intentioned, are sort of offering a very unrealistic dream about the future and will have technologies that fail. And on the other side, we think there's alternative businesses that will be like some of the major tech companies in the early 2000s, creating a new paradigm. Because that's what's happening, a major shift in a global market that's going to have huge winners. And so, when we look across this world, both traditional and alternative will have major winners and major losers. Within the particular themes that we're focused on, so I'd start with one which maybe folks don't pay as much attention to, and that's the energy efficiency enablers. Energy costs have risen quite a bit, and we think they might continue to rise. And so businesses that help the global economy consume energy more efficiently, we think have a huge investment opportunity and the potential to generate great returns by offering savings to their customers. We also like traditional energy businesses that are returning cash to shareholders. and sort of sticking by their traditional business models. We also like traditional energy businesses that have what I would consider credible energy transition plans, where they can use the cash flow they generate in their legacy businesses to transition with the energy markets going forward and become big players in the alternative space. I would also say on the alternative side, we really like batteries. We think that that is going to be one of the critical drivers of adoption and improvement in the usability of alternative energy. And then also nuclear, which though has been somewhat controversial in the past, we think does check a lot of boxes when it comes to things like environmentally friendly, baseload, predictable, low variable costs. So those are some of the things that we're excited to invest in today. So one of our sort of core views here is we think the definition of energy has been sort of misdefined, or maybe said better, you need to redefine it going forward. And what we see is a lot of investors that want to get access to energy are sort of left with almost a zero-sum choice. There are investment products, both passive and active, that are focused on traditional resources. And those are, we think, highly concentrated, pretty volatile. They oftentimes don't have any access to alternatives and new technologies directly, only embedded within the companies that they own. And they're also sort of the old energy guard. Conversely, there are lots of transition funds and alternative funds, which are 100% new technologies, which also, though can offer a lot of growth, are very volatile. And you'll see a lot of losers within that basket. When we think about the future of energy in 2040, we see a world where it's going to be about 70% traditional and 30% alternative by generation or by market share. And we actually think you need to redefine what energy is and include a universe that has some traditional businesses, some alternatives businesses, some businesses that other folks aren't paying attention to. And doing so gives you a much broader and more comprehensive exposure and approach to energy as an asset class. When you do this, it's actually highly complementary. So if you look at the data over the last 11 years, 7 of the 11 years when traditional's up, alternatives have been down and vice versa. So they really do act to sort of smooth and improve risk-adjusted returns. And what I'd end with is it's not just about redefining this universe and sort of creating this new sandbox of the future of energy, but specialists, we think, are really in a huge advantage because there's going to be lots of change, lots of disruption, and huge alpha opportunities for active managers to sort of sift through the transition and all it's doing and find those businesses that are going to do really well and generate a lot of alpha and total return.